Today, we are jumping straight into, well, the eye is a financial storm, the natural gas market. And specifically, we're dissecting an analysis report that focuses on a vehicle that right now really embodies extreme fear. I'm talking about the leveraged ETF, BODL.
Right.
Now, if you just read the headline, natural gas dead, wrong. You might think it's just pure recklessness, but we're here to unpack why this report suggests the very panic driving the price down is mathematically setting the stage for a pretty explosive short-term reversal.
That's really the paradox we have to navigate. We're doing a deep dive into the source material here, and it's all about the ProShares Ultra Bloomberg Natural Gas ETF. This is an investment vehicle that has just had a catastrophic fall.
I mean, it's just been a bloodbath.
Exactly. It's down over 85% from its 52-week high, trading as of January 10th, 2026 at just $15.73. So our mission today is to understand why, despite all this bearish sentiment, some pretty sophisticated analysts believe BODL is now, and I'm quoting, mathematically primed for a violent mean reversion bounce. And crucially, what aggressive risks you absolutely have to watch out for.
Mathematically primed. I like that. It suggests we're kind of past the point of fundamental doubt and we're now in the realm of, what, statistical inevitability?
Given the setup, yes. The report's whole premise is that this is the classic despair phase that, comes right before a massive technical recovery. To even start to grasp the potential volatility, you first have to understand the instrument itself.
Okay, so let's define our battlefield. BODL has been dominating volume lately, I've noticed, precisely because of this price collapse. What exactly is the ProShares Ultra Bloomberg Natural Gas ETF, and why does the analysis report call it a tactical weapon?
It's called a tactical weapon because its mechanism is geared exclusively towards short-term volatility. It gives you 2x or 200% daily leveraged exposure to the Bloomberg Natural Gas Subindex.
Okay, so in simple terms, if the underlying price of natural gas moves, say, 4% in a day, BODL is designed to move 8%.
That's it. Double the potential reward, but it also means
double the pain, which we've definitely seen lately.
Precisely. And this double exposure is why the official warning about it is so stark. It is explicitly not a buy and hold investment. It's really only for aggressive traders betting on short, sharp moves.
And this gets us to that critical concept, the one that always seems to trip up retail investors.
Yeah.
Why can't you hold this long term? We hear the terms beta slippage and time decay all the time. Can you, really simplify that for us?
It is absolutely vital to understand this. Holding BODL long term pretty much guarantees losses because of the daily compounding of returns. That's what beta slippage is.
Okay.
Think of it like this. If natural gas goes up 10% on day one, BODL gains 20%. Great. But if natural gas then drops 9.09% on day two, it's right back where it started. BODL, though, it drops 18.18% from its new higher value.
Oh, so its overall value is now actually below where it started, even though the gas price is flat.
Exactly. You are guaranteed to lose money over time. The time decay is just relentless because that leverage resets every single day.
So it's an acceleration pedal, not a parking spot.
That's the perfect way to put it. That's why analysts treat it as an instrument you hold for days, maybe weeks, never ever months or years. Currently, the fund has a pretty sizable AUM, assets under management, around $506 million. And it's focused on those near-term futures contracts, Feb and March 2026, which is what ties it so closely to these winter weather forecasts.
Okay, we get the tool. Now let's talk about this this moment in time that's created the opportunity. We've seen a waterfall decline, down 22% in just the last 3 days, which led to that 85% decline from the high of, what, $109? Why is the market so aggressively negative right now?
The panic is, I'd say, 90% driven by immediate warm weather forecasts. We're in the middle of winter, and the perception of lower than expected gas consumption for late January has just triggered this extreme fear sentiment.
And because it holds those near-term futures.
Exactly. Even just the threat of lower heating demand causes futures prices to crash, and that leads to widespread retail. Well, capitulation. Traders who are betting on a cold snap are being forced out.
And this forced exit, this moment of capitulation, that is exactly what technical traders look for, right? What indicators are screaming that BODL is now oversold and maybe at its absolute bottom?
You've got a confluence of 4 classic signals. First, the price hitting that fresh 52-week low of $15.72 yesterday. That confirms maximum pain. Second, the relative strength index, the RSI.
A key momentum indicator.
Right. It's reading under 5. Now, an RSI under 30 is textbook oversold territory. Under 25 is, well, it's historic for this vehicle. It's like a rubber band stretched so tight it just has to snap back.
So beyond the RSI, what else confirms this extreme level of fear?
Third, implied volatility, or 5 for the ETF, is spiking. It's above 90%. High 5 means the market is expecting massive, violent moves in the near future. And finally, the average daily volume. It's usually around 13 million shares, but It has spiked dramatically during this drop. Spiking volume on a massive decline is the absolute signature of capitulation. It's that moment the last of the weak hands just panic and sell.
Now, the analysis highlights that this mirrors the despair phase we saw right before the December 2024 winter rally. But let's play devil's advocate here. Is comparing 2026 to 2024 really a clean comparison? I mean, weren't the underlying storage levels or the export capacity different back then? Is history just wishful thinking here?
That's a fair challenge, a really good one. And while the fundamental supply numbers are, never identical, the behavioral pattern is it's a mirror image. In 2024, the market feared storage overruns, dumped the ETF to similar technical extremes, and then what happened?
Better retire.
BOL rallied 100% to 200% in a few weeks when the weather finally turned. So the key takeaway from the report isn't about the exact fundamental data, but the certainty of the technical setup that happens when fear gets this extreme.
Okay, so maximum technical fear is setting the stage. But technical extremes don't last unless there's a fundamental reason for a recovery. What evidence suggests that the big money, the institutional analysts, aren't buying this warm weather narrative long term?
This is where we get to the hidden bullish divergence, which is the structural floor that all this short-term weather noise is masking. The institutions are looking past February. They're focusing on two massive, unavoidable tailwinds for natural gas demand that create this floor.
Let's start with the biggest one, LNG, liquefied natural gas export demand. The report mentions a projected record high demand expected in Q2 2026. Why does Q2 matter so much right now, in the middle of winter?
It matters because of the global shift in energy security. Europe is still desperate for U.S. supply to replace Russian gas. Asian demand is robust. This long-term need makes U.S. LNG a geopolitical necessity. What the institutions are tracking is the imminent ramp-up of U.S. export capacity.
You mean places like Plaquemines and Corpus Christi?
Specifically those terminals, yes. The physical ability to ship U.S. natural gas out of the country is about to increase dramatically.
And more capacity means?
An inevitable structural increase in demand for Henry Hub gas, regardless of whether it snows in Boston next week. Analysts see this ramp up as an absolute floor for gas prices. This is the conviction they need to make an aggressive short-term trade.
So that's the geopolitical floor. What about the secondary demand factor, the one that's emerging so quickly?
That would be the booming demand from power generation for AI data centers. The expansion in AI infrastructure, you have to think massive server farms being built everywhere, they require enormous, constant, reliable electricity.
So unlike residential heating, which is seasonal, AI demand is constant and growing. It's creating a whole new baseload.
Precisely. You have high demand pressure from two totally distinct structural areas, global LNG and domestic tech. And when you combine that kind of support with the current extreme panic, well, it creates the perfect setup for a high-velocity event.
Which brings us back to the vehicle itself. When extreme lows meet this kind of structural inevitability, we start talking about a short squeeze. Are we in squeeze territory?
Absolutely. The share statistics confirm it. The fund's float is turning over rapidly. You have high short interest. BOL is in maximum squeeze territory. If any positive news hits, even a minor supply disruption or a small shift in the forecast, the shorts are going to rush to cover all at once.
And that covering creates explosive upward pressure,
which is then amplified by the 2x leverage. It's a feedback loop.
That confirms the setup. So let's get to the technicals. What specific patterns are traders watching for that would signal the start of this reversal?
The main pattern is a classic falling wedge on the daily chart. This shows the rate of the price decline is actually slowing down, the wedges are tightening, even as the price makes new lows. It signals selling pressure is just running out of steam.
Okay, and what about yesterday's trading? That huge red candle that closed right at the low? That must have terrified anyone left holding it.
That candle is technically known as a massive red marubozu. In Japanese candlestick charting, it means bald because it opens high and closes at the low with no wicks. It signals overwhelming seller dominance.
Which sounds terrible.
It is terrifying, but it often acts as the final knockout punch. It signals the market has completely run out of weak hands to sell. It frequently marks the precise low right before a swift V-bottom reversal.
So the Marubozu is the exhaustion signal. If that's the low, what is the clear confirmation traders need to see to actually jump in?
The required confirmation is a strong, definitive green candle on the next trading day, so Monday, January 12th, that breaks the Marubozu's high. That would signal that institutional buyers aggressively stepped in right when retail capitulated. That confirms the V-bottom pattern has started.
Okay, let's talk risk. Every high-reward trade has a clear point of failure. What's the key support that absolutely must hold for this whole bullish idea to work?
The entire speculative scenario relies on the underlying Henry Hub natural gas futures, holding the key psychological and technical support level of $3 per MMBtu. If that level breaks, And I mean convincingly, the structural floor is gone, the bear case is on, and the whole premise just falls apart.
So let's break down that risk reward. The analyst rating is a speculative BUY, but only for aggressive traders. Why is buying at $15 so much better than, say, at $50?
Because you're buying closest to that fundamental line in the sand, the $3 Henry Hub support. Your risk is now tightly defined. If the trade fails, your loss is limited to that $12 target. But if it works,
the potential upside is hugely amplified because you bought at the moment of peak panic.
Exactly. You are buying into maximum despair, which is often the highest conviction moment for contrarian investing.
Okay, given that risk definition, what are the specific price forecasts in a report? Where could BIL actually go?
The report lays out 3 clear scenarios. First, the immediate short-term bounce, just based on the oversold technicals, targets $24.50. That's a gain of about 55%.
A 55% gain in a short period. Not bad.
Then there's the true bull case. This one relies on a confirmed February freeze or a major cold snap. That sets the target at $45, an astonishing gain of 185%.
Nearly triple your money if the cold hits and the shorts panic. That is the definition of high-stakes volatility.
And conversely, the bear case. This is driven by continued warm weather and a break of that crackle $3 Henry Hub support. That puts the downside target at $12, which is a manageable 25% drop from here. The analysts are very clear. This is high risk, but extremely high reward.
What a remarkable tension. You have this leveraged vehicle down 85% from short-term weather noise, yet it's resting on this firm foundation of massive projected global demand from LNG and AI. It's fear versus long-term inevitability.
And that tension is about to run straight into some major immediate catalysts. You need to keep an eye on 2 specific dates coming up that could be the trigger.
Give us those dates.
First, January 15th, 2026. That's the next EIA natural gas storage report. If that storage draw is surprisingly high, meaning consumption was stronger than expected, that could be the immediate trigger for that V-bottom confirmation candle.
A bullish surprise would send short scrambling. And the second date?
January 29th, 2026. That's the February futures expiry. You should expect extreme volatility around then as traders roll their positions. This squaring up of bets, especially near an oversold low, is often when the market makes its final dramatic move for the winter.
So we're watching a highly leveraged, technically oversold asset where the slightest structural shift could trigger a parabolic move. It's a temporary disconnect between price and structural reality.
Absolutely. And that raises a really important question for you to think about. If these extreme technical oversold conditions and the record high short interest meet the first headline confirming a serious polar vortex or significant production cuts, how quickly will Boyle's high implied volatility translate into that projected V-bottom reversal? And what are the deeper implications for the broader energy market beyond this aggressive short-term trade, especially concerning the growing structural importance of U.S. LNG exports?